Hi everybody, and welcome back to video number 3 in chapter 20. And when we left off, we were looking at budgeted cash receipts and the timing of that. And you'll remember that we started with our schedule of sales here in dollars, and then our cash receipts that we made that were staggered a little. And now we prepare our schedule of cash receipts from sales. And we start with our cash sales here that we had. And then we also have our collections from one period ago, and then collections from 2 periods ago. So we can look back here at 60% of 48,000, and then we can have 60% of 60,000 here. All right. So our total cash receipts then for December would be $62,040. All right, cash payments for direct materials. Here we had our material purchases that we calculated, and now we're going to make some cash payments for purchases. In October, we don't have any current period purchases, but prior period purchases, we're going to look back to September and purchase that in October, because we have a 30-day waiting period, essentially, until we need to pay for those direct materials to our suppliers. Now, over several periods then, we have cash payments for our current period purchases, perhaps, and then 80% would be prior period purchases. So that would show you a schedule of cash payments for direct materials over several periods, which is usually the case. So now, preparing the cash budget, let's look at October's beginning balance. We add the cash receipts from sales. So we have our cash available. Then we have all our cash payments for direct materials, direct labor, variable overhead, sales commissions, sales salaries, administrative salaries, income taxes, dividends, and then interest on the loan. We said that that's 1% of the outstanding balance, which in this case would be $10,000 times 1% for October. And then we have no purchase of equipment, and so our cash payments total $43,565. So our preliminary cash balance here is $25,635. We don't need an additional loan because we repaid down $5,635, which leaves us an ending cash balance of $20,000, which is our goal. And then our loan balance goes down from $10,000 down to $4,365. Now, that $20,000 now becomes the next period's beginning cash balance, and we go through the same process. And our preliminary cash balance here is $43,246. Times are good, so we repay the remainder of our loan. And that gives us an ending cash balance of $38,881 with no loan balance at the end of the month. Now, from the standpoint of paying off our loan for November, we have the $4,365 loan balance at the end of October, and that requires us to pay $44 in interest in November. So now we take that $38,000 ending cash balance, we bring that up to December, we work through the same process, and we've paid off our loan. We have no interest expense, but we do purchase a piece of equipment for $25,000. And then that still puts us in a good cash position, and away we go. So you can see that preparing the cash budget can be quite complex as we go through these various cash payments and cash receipts. Okay, for loan activities, I think you saw that in the last schedule. We started with a beginning loan balance of $10,000, and we paid our 1% of that $10,000 here in interest, right? But then we paid down a good portion of that, and we have $4,365 left. We take 1% of that. That's our monthly interest rate, which is based on 12% for the year. And our interest cost is a mere $44. And then in December, we don't have any loan balance, so we have no interest expense. All right, let's take a look at the budgeted financial statements now. In the budgeted financial statements, we can now forecast our 3 months. And here's our sales forecast, our cost of goods, our gross profit, our selling expenses, our G&A, and that includes the commissions and then the fixed salaries, and then our administrative salaries, and finally our interest expense. And so that gives us our income before income taxes. We pay 40% tax rate, so that's leaves us with $59,254 of net income. So all that information in that budgeted income statement is taken from the component budgets we've examined on the previous slides. The predicted amount of income tax expense for the quarter is just simply computed at 40% of the budgeted pre-tax income. And we, of course, include that as one of our expenses. Okay, our budgeted balance sheet, same kind of thing here. We did need to add the $25,000. Let's go back. And they don't give us a preliminary balance sheet. Okay, so that would include our purchase of $25,000. Sorry for all that toggling, but I thought we had a beginning budgeted or actual balance sheet through the first 9 months of the year. So in any event, we can now compute our budgeted balance sheet. And now if we change tack a little bit and look at budgeting for service companies, the service companies here also use master budgets, but they have fewer operating budgets than manufacturing companies, and for that matter, much less sophistication. Here we have our sales, but we only have direct labor, and then that results, we still need to compute capital expenditures, and we have selling and administrative expenses, and finally our cash budget. So How would we prepare a direct labor budget for a service firm and analyze the revenue per employee? Well, here, our budgeted direct labor cost is equal to the budgeted direct labor hours times the direct labor cost per hour. Pretty similar to manufacturing. So data and manufacturing, data mining and analysis takes so much hours, and staff investigative analysis takes so many hours, and a senior forensic accountant takes so many hours. And we can blow that through by differing direct labor costs per hour. I think you could easily see how that could be used for a law firm, or for that matter, an accounting firm, where we have different pay grades for each level of support. So now, if we look at the total revenue that Microsoft has per year, and we divide that through by the number of employees, that's a substantial $842,443 of revenue per employee. And Microsoft has an even better version of that, and Hewlett-Packard has an even better version of that. So these are substantial revenues per employee. Now, if we look at each component of a master budget for a merchandising company, we can see that we have certainly a simpler version of a manufacturing company, but we have purchases in this case, budgets rather than a production budget. So we purchase finished goods, put them on the shelves, and sell them directly that way. Again, our capital expenditures and our selling expenses and general and administrative expenditures. And we prepare that merchandise budget the same way we do for pretty much the same way we do for manufacturing. Here, our units to purchase are going to be our budgeted sales in units, our desired ending inventory. We'll add that and subtract out our beginning merchandise inventory. So if we look at that for the hockey den, here we've done just that. We start with our budgeted sales units. We add our desired ending inventory, which is 90% of future sales, just like it was with our manufacturing company. We do it the very same way. And we back out our beginning inventory units, and that gives us our units to produce. And then we can simply take those units and divide them into the cost of those merchandise purchases, and that would be $60 cost per unit. So the ending inventory for a month in units should equal 90% of the next month's unit sales. Okay, now scheduling of cash payments, we're going to do similarly to the way we did the manufacturing budget. We'll start with our purchases here. We have our current period purchases. We look to our prior period purchases, and that's going to give us the cash payments for merchandise purchases. And as it says here in this footnote, 60% of prior period purchases equal the prior period accounts payable balance for this company. So we're going to subtract the beginning inventory to determine the budgeted number of units to be produced, or to be purchased, I should say. Okay, that looks like we have ended chapter 20. And when we return, we'll start into chapter 21. Until that time, bye for now.